After the UK officially triggered the process of leaving the EU on March 29, the French presidential candidate from the Front National, Mrs. Le Pen, is striving for a similar EU referendum in France this year. The market impact from an unexpected victory of Mrs. Le Pen would be huge. It would question the very existence of the EU in its current form. Not only would French OATs come under pressure on fears of currency redenomination, also Southern European debt would suffer on concerns of a wider breakup of the EU. By contrast, German bunds, the US dollar and the Japanese yen would benefit strongly. In fact, Le Pen seems on course to make it to the second round of the elections, which will be held on May 7. But despite the substantial concerns, her chances of actually winning the runoff are still small. Her strongest opponent, the reform-minded and pro-European Emmanuel Macron, is maintaining a lead in polls of more than 20 percentage points. And the constitutional hurdles for actually triggering a referendum on Brexit are high. So very much is at stake for France and Europe alike, but we would caution against getting overwhelmed by pessimism ahead of the French elections. Political uncertainties not only originate from France. In Italy, support to Eurosceptic parties is rising. The UK has just triggered the start of Brexit negotiations, which are likely to be tough. And in the US, President Trump has so far failed to organize political majorities for key ambitions like a healthcare reform. And yet, global business confidence is on the rise, defying the gravitational pull from uncertainty. Last year's Brexit vote caused little harm to the global economy. Financial markets equally shrugged off Renzi's lost constitutional referendum in Italy last December. A surprise victory by Le Pen in France may cause bigger harm to the euro area economy via financial market disruptions. But overall, we deem the cyclical momentum strong enough to prevail over current political uncertainties. In the US, the labor market remains very solid, while investment spending is picking up. And in the euro area, the composite PMI, a timely bellwether of the economy, rose to a 6-year high in March. Barring a surprise victory of the extreme right in France, we expect the solid data flow to remain strong enough to counter the political uncertainties and to continue to set the tone on financial markets over the coming weeks. The Fed has accelerated its path of rate normalization, hiking its key rate by 25 basis points to the range between 0.75 and 1% in March. And yet, US yields have fallen lately. The Fed had barely changed its rate outlook at its last meeting, and this has fueled market skepticism about rising rates. We deem these doubts overdone. With inflation in the US on the rise and the US economy supported both by a strong labor market and improving global data, we anticipate 2 further rate hikes by the Fed this year, with the next likely in June. By contrast, the ECB will remain highly accommodative for longer, despite the recent pickup in economic data. As already announced in December, the ECB will buy only 60 billion of bonds each month from April onwards, 20 billion less than before. But we expect the ECB to stick to its plans to wait until next year before gradually tapering its purchases to zero. And an outright first rate hike is a matter only further out in the future. Upside pressures on US yields should thus be more visible again soon, but with only limited effects on European ones. And barring a political earthquake in France, risky assets in Europe may still hold up well amid decent economic data and continued monetary policy support from the ECB. Thank you very much for your attention. We will keep you posted.